Live from our headquarters in Baghdad, this is Iraq Now. We bring you the latest developments across the region.
The $55 barrel, how global oil oversupply threatens Iraq's fragile economy. The global crude oil market is once again at a critical inflection point. After a period of relative stability and even price surges earlier in the year, the market has entered a distinct bearish phase. As of early December 2025, benchmark crude prices Brent and West Texas Intermediate (WTI) are trading in the high $50s to low $60s per barrel, a significant retreat from their 2025 highs. This downward trajectory is not merely a short-term correction, it is a signal of a fundamental shift in the supply-demand balance, one that is projected to deepen in the medium term. For oil-dependent nations, this trend is a cause for profound concern. Nowhere is this anxiety more acute than in Iraq, a country whose economic stability is almost entirely tethered to the price of a single commodity. The projected oil slump in 2026, with some forecasts placing Brent crude as low as $55 per barrel, threatens to unravel years of fragile macroeconomic progress and plunge the nation into a severe fiscal crisis. Here we analyze the recent crude oil price fluctuations, dissect the factors driving the bearish medium-term outlook, and examine the catastrophic economic implications for Iraq, a nation desperately needing prices nearly double the current forecast to maintain fiscal solvency. The recent slide in market drivers. The current market environment is characterized by a persistent downward pressure that began to solidify in the latter half of 2025. The price of Brent crude, the international benchmark, closed the first week of December 2025 at approximately $62.32 per barrel, while WTI, the U.S. benchmark, settled near $58.48. This represents a continuation of a downward-sloping parallel channel that has defined the market since October 2024, indicating a structural rather than cyclical decline. The primary forces behind this bearish turn are a potent combination of surging global supply and a deceleration in demand growth. The supply surge, non-OPEC dominance. The most significant factor driving the oversupply narrative is the relentless growth in non-OPEC production, particularly from the United States. U.S. shale producers have demonstrated remarkable resilience and efficiency, consistently exceeding production forecasts. This output, coupled with increased production from other non-OPEC nations, has created a substantial buffer against any attempts by the Organization of the Petroleum Exporting Countries and its allies, OPEC+, to tighten the market. The OPEC+ alliance, which includes major producers like Saudi Arabia and Russia, has been the market's primary stabilizer through coordinated production cuts. However, the alliance faces an increasingly difficult dilemma. In the face of a growing global surplus, maintaining deep cuts means sacrificing market share to non-OPEC competitors. Conversely, unwinding those cuts, as they have signaled a willingness to do, only exacerbates the oversupply and accelerates the price decline. The market's interpretation of OPEC+'s recent policy signals has been one of cautious pessimism, contributing to the downward price momentum.